Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim.
And Jim, thanks for always for having me.
Tim, has the Fed put so much quantitative easing and other incentives into the stock market, there's no need to worry about it anymore? Things are just, quote, back to normal, as normal as things can be.
Well, I think that's what people maybe think or hope, but I don't think it's the case. The Fed can certainly influence the market. If the last 10, 15 years has proven anything, it's that. But I don't think that's where we're at. I still think this is a counter trend bounce before the next leg begins.
So when you say a counter trend bounce, does that mean it's kind of what some people in aviation call a sucker hole? That is a nice blue patch of sky you think is going to be smooth and non-turbulent, but just as you get there, the bad weather closes in.
Yeah, maybe the eye of the storm type thing. And I don't know how big the eye is just yet, but I think the storm is pretty big. Let me explain. Let me digress for a minute back to the Fed, the market versus the Fed sort of thing. And we've talked about this before. I'll say it again. One of the biggest tools the Fed really has is the illusion that they have a tool. And let me explain that. I'm not saying they don't have a tool, because they do. Their tool is their mouth, or their biggest tool, in my opinion, is their mouth. And an example of that, if you go back in time and you look at, say interest rates, and I've always said that the Fed follows the short-term markets, and they do. It's a matter of putting you can go by the Fed funds rate or the discount rate and the short-term T-bill rate, 90-day T-bill rate in a spreadsheet, and you can graph it and look at it, and it's real simple. They follow. And sometimes they'll let the spread between the two get a little wider, depending on how aggressive they are, and sometimes a little narrower, but they follow that. And a perfect example of that, back in November, December of January of 18, there's a 3 and a 10-year cycle in the bond market, and those cycles bottomed, and as they started up, rates started down, and of course, that's where the turn came, because remember, back, the following Fed meeting in December, that's when they turned dovish. They said, all of a sudden their language changed and that sort of thing, and that's because those cycles checkmated them. They bottomed and rates turned, and they started following. And then it wasn't until like May or really June before the short-term end started to break down last year, and then that's when the rates turned. And I think, like I said, since this first leg down in March, they came out and did all of their QE and bailouts or whatever you want to call it. And I think the perception is that they have fixed things, and they have for a while. How long? I'm not sure until we get another setup to cap this advance. The structure will tell us. They don't negate the structure. They can negate things. They can extend the cycles. They can, manipulate the market that way. But ultimately, just like the structure set up to cap the top back in January, February, the structure will set up to cap this counter trend advance. When that comes, I don't know, but we'll see it. And when it does, then it's going to tell us that, the opportunity for the market to turn down is certainly going to be at hand. It's going to put the market in a vulnerable position. And if they can't pull another rabbit out of the hat by making the market believe that, they have more tools in store, then that setup takes hold and it's done. If they can somehow buffalo the market into believing that, they can continue to save it by, again, the lip service that they give the market, then of course they can extend that, and that setup will be blown out just like we saw going into the bubble top. But ultimately, the market will checkmate, and then when it does, the cycles, the structure will tell us, and then nature will take its course.
How coordinated are the efforts by world central banks to try to prop up stock markets around the planet?
Oh, boy. That is an excellent question. And you were talking about us thinking alike before we came on. Perfect question. This has been going on from my seat. I've observed this really since 2015. And every time the market would get in a vulnerable spot where it was just like on edge of a setup, and when I know that doesn't make a lot of sense for someone not reading the material and knowing what I'm talking about when I talk about the cyclical structure and so forth, but, market has structure, and it's just like the structure of a house. If it's strong, everything's good, and if it's weak, then, it'll fall down. And eventually there has to be, weak structure has to take place. And once we see that, then, nature takes its course, but that structure has to be built. Well, as we would come to a technical juncture and we'd start to see the structure of the market turn, if you will, turn weak so that the cycles would turn, a top would be trying to take hold, is what I'm trying to say. That's where we would see it attacked. They would come out with, we got a trade deal with China, or, the jobs reports, or, inflate something. They every time they'd come out with their mouth, is what I'm saying. They would come out and BS the market into this grand illusion right at these critical points when it's a house of cards. And they have done that, and that's how they have kicked the can down the road over and over and over and built the bubble that we had. None of that has changed. It's still the same bubble. It's still an unwinding of the same process, and now we have this, virus phenomena going on top of all the unemployment, the weak economic data that got us there in the first place, and now that, the data, the underlying data is even weaker. So, nothing has changed. It's a counter trend advance. Can they blow it up? How long they can keep it going? I don't know. But we will see the structure, and when we do, I think it's going to be very detrimental to the market.
We'll have more with Tim Cyclesman Wood right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. I'm speaking with Tim Cyclesman Wood. Tim, what if some hedge funds decided to get together and manipulate the market? They apparently have more money than the Fed has to throw around.
I think that may be happening. One thought, and I have nothing to go on, but imagine this. Say we come out and say, hey, we got a deal with China, going back to the trade deal. And then there was mysterious buying in here in response to that news from some hedge fund or whatever that drove prices, and people see the buying. You see what I'm saying? And then it just, one thing feeds on the next, and it just, does it change anything? No, it blows the bubble even bigger, but does it change the underlying economic conditions and the real state of the economy? Does it change the fact that it's a bubble that's being blown even higher? No. But can they do that? Absolutely. And I think that has been going on. And a lot of that is just general perception, because people see that sort of thing. They hear the news, and then it becomes, perception becomes reality for a while. But ultimately, like I said, they can distort, they can stretch, they can extend, they can manipulate, but you can't negate, ultimately, the bubble. It's how long can they continue with the game. And we're kind of back in the same situation that we were moving into in building the top. It took forever. We'd see things get blown out. Nothing would ever really bite. And now we're looking at that on a lower level, if you will, because, like I said, it's counter trend, but it's the same sort of thing. Structure has to take hold, and until it does, this game can go on. But I think it's counter trend.
For investors, what do they have to really look out for?
Man, the risk. It's like I was talking to a money manager friend of mine the other day who was talking to a money manager friend of his, and he was saying that, there's the risk is certainly, if you know, or if you think you know and understand the environment that we're in and the downside risk, and how, all of a sudden structure can fall in place, and then you're exposed to the downside. But at the same time, if you're not in the market, or if you're short, and some news event comes out, we got a cure for the thing, is at a strategic level like we saw the other day, then the market surges, then so there's tremendous risk both ways. Ultimately, like I said, I think the ultimate risk is to the downside, but I guess it comes back to this, the answer to your question from my eyes. It comes back to understanding the structure. And I don't mean to, well, there's no other way to look at it for me. We understood what fell in place, wrote about it blow by blow by blow by blow as it happened in January into February, and we were able to identify that because we understood structure. And that's the key. I mean, that's the best answer I can give. This is an extremely risky market either way, given the environment that we're in, because it is so manipulated, if you will, and it does have the risk associated with the higher degree setup. But at the same time, if you understand the structure when it falls in place, then I think you have at least a heads up once it does start to develop.
And Tim, I recall early in the new year, you were warning there's a huge setup here. We didn't know the virus was about to shut down everything, but you were just saying the market is tippling at a precarious edge of the cliff, and going to cash would not be an embarrassment or a problem, and it would be a good idea to just hold and wait. Did people follow your advice?
I have no idea what they did with the, I do the research, and people can do with the research as they please. I know some that did, personally, but others, I have no idea. But, we, like I said, we saw it set up, and that was because we understood the structure. And the thing is that, how do I say this? The market is like, Charles Dow described it. Actually, it wasn't Charles Dow. It was Robert Ray described it as, like you have the tides, and then you have the waves, and you have the little eddy current. So you have cycles within cycles, or movements within movements, if you will. And like I said, at the higher level, we have the structure that's set up with the bubble top, and then at the next level, we have this counter trend advance. And then we have the short term. Well, now the short term, when I talk about the structure, the short term has to evolve into something that gives the intermediate term a toehold for a downturn, for the resumption of the higher degree turn. And so that's what we're watching. And I guess I digressed on that. I don't remember if I answered your question or not, but the risk is tremendously high. And I think the key is, like I said, understanding what the market is telling us.
We'll have more with Tim Cyclesman Wood right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, what's the outlook for precious metals?
Boy. Precious metals, they have been the holdout. And again, I think that 9-year cycle top, we're pushing into, that higher degree top. But until we get a series of properly structured cycles to cap it, we cannot say that top has been seen. Now, backing up, looking at the relationship, and the reason why I say I think it's a longer-term 9-year cycle is because of those longer-term relationships with gold and all the underlying commodity-related indexes, averages, including crude oil. Everything has adhered to those historical relationships except gold. And so on the one hand, somebody may argue, well, dummy, that's telling you something. Well, yeah, it is for now, but you cannot ignore those longer-term relationships. And so, again, that's working both ends to the middle. On the one end, I understand the risk associated with the fact that it is the holdout, and I understand what it means that those longer-term relationships are there, and I think that they are valid. But at the same time, we have to see the structure. And gold has been kind of like the market. It'll try to set up, and then it wouldn't happen. It'll try to set up, and it wouldn't happen and move higher. I think that once... how do I say this? I think that once we see equities set up and a turn take hold, that the next downturn is going to be much broader base. And I think that is what's going to bring gold with it, just like what we saw in 2008. If you'll remember, and I'm not using 2008 as a model. That's not the reason I'm saying this. I'm saying this as an example. But just like in 2008, if you'll remember, initially equities peaked and then commodities followed. And I think that, we're going to see a much broader base liquidation across the board once we get into the next downturn, and I suspect that's what brings gold down, and it'll get back in check with these other relationships.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. If you have any questions for Tim, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.